Let us start with the one thing you are not supposed to see in a normal global commodities market, a permanent price gap. Shanghai prices silver near $104, while New York shows around $92. That is not a tiny spread. That is not a rounding error. That is a loud signal that something is struggling to stay aligned behind the scenes. And here's why this matters even if you never trade silver in your life. Because when the same metal has two different prices in two major hubs, price discovery stops being global and starts being political, logistical, or trust-based. And when trust becomes a variable, you don't get smooth markets anymore, you get sudden repricing. In a perfectly functioning system, this gap should close fast. Arbitrage is supposed to crush it. Traders buy where it's cheaper, sell where it's expensive, and the spread disappears. That's how it works in textbooks. And for small differences, it usually works in real life too. But when a spread stays wide and stubborn, especially for a metal as widely traded as silver, it's telling you something. The normal bridge between regions is getting heavier, slower, or partially blocked. Now I want you to picture this like a simple real-world example. Imagine two gas stations on the same highway. One is selling gas for $3.80 and the other for $4.30. If that difference stays for days, everyone would drive to the cheaper one until the price adjusts. So if it doesn't adjust, the only explanation is friction. Something is stopping people from accessing the cheap supply, or something is making the expensive supply more valuable right now. That's exactly what this Shanghai versus New York gap represents. Time, certainty, and delivery are suddenly worth more than they were a few months ago. This isn't just silver went up. Essing silver is being treated differently depending on where you are and what form you need. And that takes us to the most important question in this entire video. If New York says $92, but Shanghai pays $104, why doesn't every ounce immediately flow to Shanghai to capture the profit? Why doesn't the market instantly fix itself? Because in practice, there are real barriers. Shipping is not free, insurance is not free, financing is not free, customs delays are real, regulations are real, contract terms are real, and most importantly, not every ounce of silver in New York is actually available for you to grab and ship. It might exist on paper, but it's locked inside structures built for trading exposure, not moving metal. So the gap is not just a price difference, it's a stress test. It is the market asking itself a brutal question. How much silver can you actually move when someone is willing to pay more for it somewhere else? And when that question starts getting asked out loud, we see the same pattern again and again. We see physical premiums rising, we see delivery behavior shifting, we see inventories becoming more important than price charts. We see the difference between paper silver and metal silver stop being a meme and start becoming a business decision. Now here's the thing I need you to understand before we go deeper. This video is not a promise that silver only goes up. That's not how real markets work. Silver is volatile. It can spike and it can smash down in the same month. But what I'm showing you is bigger than any single daily candle. I'm showing you a structural signal, a market where the price is no longer just a number on a screen, but a reflection of who can deliver and who cannot. So in the next section, we're going to break down what actually creates this kind of gap. The three forces behind it: logistics, friction, physical tightness, and the convenience yield of having metal right now. When people hear arbitrage, they imagine a clean machine. Buy low here, sell high there, profit instantly. But in real physical commodities, arbitrage is more like moving a heavy couch up a staircase. You can do it, but the stairs matter. The hallway matters, the timing matters. And the moment the building adds locks and rules, you don't get to move anything unless someone lets you. Let's break this down into the simplest possible truth. Shanghai is paying a higher price because the physical market there is valuing immediacy and certainty. New York is showing a lower price because the paper market there is valuing liquidity and contract settlement. If those two worlds were perfectly linked, the gap would vanish. But they're not perfectly linked. One reason is form factor. An ounce isn't always an ounce in the real world. A bar that meets exchange standards is not the same thing as a coin in your hand. A wholesale bar sitting in a vault is not the same as minted product in a dealer S inventory. And if fabrication is a bottleneck, the physical market can scream even while the paper market stays calm. Another reason is timing. Even if you can buy metal at $92 in New York, you don't teleport it to China, you ship it, you insure it, you finance it, you clear it, you convert the form if needed. And every step introduces risk. If the price moves against you during transit, if rules change, if financing costs rise, your risk-free trade stops being risk-free. But the biggest reason arbitrage fails is the one most people avoid saying out loud. Counterparty and accessibility. Not all metal is truly available to be removed. Some of it is held inside systems designed to trade claims, not facilitate mass withdrawal. If too many participants try to turn claims into actual bars at the same time, the system doesn't explode instantly. It tightens conditions. It becomes selective, it gets slower, and that slowness is the friction you're seeing reflected in the spread. Now, here's a concept that sounds boring but is actually explosive: the cost of immediacy. In tight physical conditions, metal today becomes more valuable than metal eventually. That means near-term delivery can command a premium over future settlement. You might see it in the futures curve, you might see it in spreads, you might see it in premiums staying high even when spot dips. This is where the market starts behaving like it's pricing a different product altogether. New York is pricing exposure, Shanghai is pricing supply, and when supply matters more than exposure, you get a new kind of buyer entering the room: industrial buyers. These are not speculators. They don't care about a perfect entry. They care about continuity. They care about production schedules. Electronics, solar, high-spec manufacturing, defense supply chains. These buyers treat silver like oxygen. They might negotiate, but they don't wait for a dip forever. So when a dip happens and it gets bought immediately, that tells you the buyer mix is changing. It suggests demand has a non-negotiable layer, and that layer makes weakness shorter and recoveries faster. That's why this gap is so important. It's not just China pays more. It's telling you that real-world demand is concentrated somewhere that can pay for certainty and delivery. Now add one more ingredient: financing conditions. When rates are higher and credit is tighter, holding large physical inventory is expensive. That means fewer intermediaries are willing to warehouse metal just to smooth the system. The buffer shrinks, and when the buffer shrinks, even moderate demand shocks create outsized spreads. So when people ask, is the market broken? I answer it like this: it's not broken like a light switch. It's stressed like a bridge with too much weight on it. The bridge might hold, it might flex, it might get repaired by flows and pricing. But if the load keeps increasing and the buffer keeps shrinking, the bridge eventually forces a reprice. Now in the next part, we're going to look at the visible signals that usually show up alongside these gaps: inventories, withdrawals, and delivery behavior, and why those three things matter more than any headline. Here's the part that separates entertainment from real analysis. When a price gap appears, the market always tells you if it's serious through behavior, not through commentary. The behavior shows up in three places: inventories, deliveries, and the preference for physical control. Let's talk about inventories first, because this gets misunderstood constantly. Inventory numbers move every day. That alone doesn't mean anything. Metal moves between categories. Metal moves for financing deals. Metal moves for fabrication. Metal moves because a big holder reorganizes storage. So no, we're not going to panic over one daily line. What matters is persistence and direction. If visible inventories trend down over time while price gaps widen and premiums stay sticky, that's when the story gets serious. Why? Because inventories are the market's shock absorber. When inventories are healthy, you can absorb stress without repricing. When inventories thin out, the market becomes sensitive to every new buyer. Now deliveries, this is a quiet but powerful signal. Futures markets exist to hedge and discover price, not to deliver huge volumes. Most contracts are rolled or closed, which means delivery standing is a choice. When more participants choose delivery, it means they're valuing metal itself more than just exposure. That behavior can rise for many reasons, but the simplest interpretation is this: someone wants certainty. And certainty is everything in a world where two prices exist at the same time. If you believe New York's $92 is real, you hold paper. If you believe Shanghai's $100 is real, you try to secure the metal. This is where the psychology changes. You stop thinking like a trader and start thinking like a supply manager. Holders begin asking questions they didn't ask during easy years. Where is my metal stored? Is it allocated? Can it be rehypothecated? What happens if there's a settlement crunch? What happens if I need delivery and everyone else suddenly wants it too? Most people don't think about those questions when the market is calm, because calm markets reward laziness. Stressed markets punish it. Now here's the mistake people make. They assume physical demand is only retail. Coins, bars, stackers, that's only one layer. The bigger layer is industrial, commercial, and strategic demand. You don't need a viral retail shortage for physical demand to matter. You need a persistent appetite for metal that doesn't vanish when price rises. And when that's present, the entire market becomes asymmetric. Dips get bought faster. Rallies extend further. Volatility increases because the float gets smaller. This is where the gap becomes self-reinforcing. The spread signals tightness. Tightness changes behavior. Behavior tightens the spread further by removing available supply. And the process repeats. But I want to keep this honest. There are still scenarios where this normalizes. Logistics could improve. Fabrication could catch up. Prices could pull back hard and demand could pause. That can happen. Silver is famous for making confident people look foolish. So what do we watch to separate temporary weirdness from structural shift? We watch whether the gap persists when paper price pulls back. If New York drops and Shanghai holds up, that means physical demand is not reacting the same way. If premiums remain strong during paper weakness, that suggests scarcity is not just sentiment. If deliveries stay elevated across multiple cycles, that suggests it's not a one-time fluke. And if those conditions persist, then yes, the market begins to behave like it is repricing the value of immediacy. Now, in the next part, we're going to connect this to the bigger macro framework: gold, monetary stress, and why silver often becomes the amplifier when confidence shifts. Silver is not just a commodity, it's a hybrid. It's an industrial input and a monetary metal. That dual identity is exactly why it behaves like chaos during transition periods. Gold tends to move first when macro stress rises, because gold is the pure confidence barometer. It's the asset people reach for when they question currency stability, real yields, or political risk. Gold is deep, centralized, and supported by institutional behavior. Silver usually follows, but when it follows, it often overreacts. Not because silver is irrational, but because silver is smaller and thinner. It takes less capital to move it. Industrial demand adds a floor, and retail narratives add fuel. That's why the gold to silver relationship becomes important. Not as a magic predictor, but as a signal of regime shift. When silver starts gaining relative strength, that's a sign of risk appetite moving toward the metal that can actually squeeze harder. Now combine that with the Shanghai-New York gap and you get something very specific. You get a world where macro flows support precious metals broadly and physical demand supports silver specifically. That's a powerful combination because it reduces the number of weak hands available to supply the market when price rises. And when that happens, volatility becomes a feature, not a bug. Exchanges adjust margins. Clearing members tighten risk. Stops get hit, sharp drops appear, then the dips get bought again because the underlying need doesn't vanish. This is why you'll see silver rip up, then smash down, then rip again. It's not random. It's a tug of war between paper positioning and physical constraints. Now let's speak like humans for a second. If you're watching this and you feel confused, you're not wrong. This is exactly what transition markets feel like. They feel unstable because the old rules stop working cleanly. But they also feel exciting because the new rules haven't fully settled. And when two prices exist simultaneously, the market is telling you it is negotiating a new set of rules. What are the possible outcomes? Outcome 1, the gap closes because New York rises. This is the cleanest closure because it means paper price is being forced upward to match physical reality. This often happens when arbitrage pressures intensify and delivery becomes more expensive to ignore. Outcome 2, the gap closes because Shanghai falls. This can happen if demand eases or logistics open up. It would be the false alarm outcome. Outcome 3, the gap persists longer than expected and the world slowly adapts to a two-tiered market. This is the messy outcome. It creates ongoing opportunities and ongoing stress. Now, which outcome happens depends on what breaks first, demand or supply chain friction. If industrial demand stays steady, and if visible inventories remain tight, and if financing remains restrictive, the odds increase that New York must adjust upward. But again, we stay disciplined. We don't declare victory. We watch the data points. So in the final part, I'm going to give you a simple checklist you can use every week to understand whether the market is normalizing or moving toward repricing. And I'll tell you the one thing that matters most: which price people are willing to pay when they need silver today. If you want to cut through all the noise, here's the simplest truth. A market is not broken because someone says it is. A market is broken when behavior refuses to follow the rules it usually follows. And right now, we have one rule being tested hard: global alignment through arbitrage. So here is your weekly checklist. 5 signals, no drama, just signals. Signal 1, the gap itself. Does the Shanghai premium over New York persist? Does it widen? Does it shrink? If it keeps existing in a meaningful way, that means the bridge is still strained. Signal 2, physical premiums versus spot. If spot pulls back but premiums stay firm, that's friction. If premiums collapse immediately with spot, that's normal market behavior. Signal 3, inventory trend, not daily noise. Are visible inventories drifting down over weeks? Are withdrawals concentrated? Are they accelerating? One day means nothing. A trend means something. Signal 4, delivery behavior across cycles. Not one headline month. Sustained elevated delivery interest suggests participants value metal more than settlement. Signal 5, time preference. If near-term availability is rewarded more than future settlement consistently, that's the cost of immediacy rising. And the cost of immediacy is what creates repricing events. Now let's bring it back to the title. Shanghai prices silver at $104, while New York shows $92. That gap is not just a statistic. It's a question being asked by the global system. Which price is real? And the answer is brutally simple. The real price is the one that secures the metal when someone actually needs it. For an industrial buyer, the real price is the one that keeps production moving. For a strategic buyer, the real price is the one that guarantees inventory. For a trader, the real price is the one that can be hedged and settled. For a retail buyer, the real price is the one on the shelf when they click buy. When all those realities agree, the market is healthy. When they diverge, the market is negotiating. So what should you do with this information? You don't need to panic buy. You don't need to all in. You need clarity. If the gap closes and the market normalizes, good. That tells you the bridge held. If the gap persists while inventories thin and delivery interest stays elevated, then the market is telling you to respect the possibility of a repricing phase. Not tomorrow, not guaranteed, but possible. And that is the real edge, understanding probabilities and structure instead of emotions and headlines. Because silver doesn't send a polite invitation before it moves. It moves when the system is already leaning too far. And by the time the mainstream notices, the price has already shifted. So we stay calm. We watch the gap. We watch the premiums. We watch inventory trends. We watch delivery behavior. We watch the cost of immediacy. And we let the market tell us whether this is transient friction or a structural signal. If you want, I can turn this exact script into a full YouTube upload pack right now. High CTR A/B titles, description, timestamps, and 500 character safe tags for this Shanghai versus New York video.